Okay, we'll go ahead and get started. Thank you for joining our quarterly webinar. I'm Lucy Bavarian. I'm joined today by our investment team members, John Regan, Alex Goldfarb, Connor Carew, Josh Baxa, and Xander Keogh. They will take you through today's presentation. We will conclude with a Q&A, so feel free to send questions in throughout the session. Our CIO, John Regan, will kick us off with a review of the quarter.
Hi, everybody. Thank you for joining us. We just got through celebrating we hit our 15th year of business anniversary on July 1. We celebrated by moving into our new headquarters building for our office down south in Charleston. So we would welcome visitors if anyone wants to come by. Q2 was a big rally against a small decline in Q1. And let's go right to the performance numbers, Xander. You're driving a truck, you have these four dials across your dashboard. The S&P is now up 6% for the year, but up 24% since Tariff Liberation Day. Oil is getting killed. It has declined about 9%, which is interesting given that we've got war in the Middle East and Iran threatening to shut down the straits. Interesting. Well, two observations on oil. One, drill baby drill doesn't work so great at $65. It actually only works at 85 and above. And then secondly, if Iran were to somehow get regime change, that would be 2 to 3 million barrels a day extra onto the market, because right now that oil is embargoed and going to sanctioned countries. So that would actually loosen up the oil market. So oil is not doing well in the backdrop of war and also economic, kind of boom times. 10-year Treasury yields are down, which sort of helps the Treasury's job of getting the refi done at some point or another. As we know, Trump wants lower rates, and he's willing to terminate employees to get them. And we'll see how that plays out. But I think the market is really starting to anticipate here lower rates in the next 24 months. And gold, of course, reacts the other way. Rates go down, gold goes up. Gold has gained 26% for the year. Moving on to stocks, 24% gain since Trump revealed his tariff liberation day. And, good for stocks, but if you're an international investor, moving on to the next slide, you've actually gained an extra 7 to 10% just in currency alone. The dollar has weakened about 11% for the year. That's the green line on the bottom. And if you're invested in non-US stocks and unhedged, you picked up whatever stock gain plus the currency gain. We have an overweight position in Japan. Interestingly, both the yen and the markets have rallied really strongly off this news overnight. Japan was up about 4.5%. Given this news, and the yen has tacked on a good 9% versus the US dollar this year. So if you're outside the US, you have double happiness, both with stocks and foreign exchange. If the market is a teenager that can focus on only one thing, Q1, the focus was tariffs. I'd say Q2, we've moved on to something else. Tariffs are really no longer driving the US markets. I think we're all kind of baked in on tariffs in the US, thinking that, okay, we're going to get these deals. And as you can see, right before we got on this call, the EU is supposedly striking a 15% tariff, similar to what they did last night with the Japanese. So 15 apparently is the number we're settling at for both the EU and Japan. Have we actually made progress on these negotiations? Going to the next slide. We have to move now. EU moves over to the left. UK, Vietnam, Japan. So some of the big ones have gotten settled. So we've now kind of settled 6. And Japan and the EU are settling at 15% tariffs. So the next big ones up are really Canada, China, and Mexico. And those are kind of interesting. Those are the biggies. And China at the top of the list. So the tariff thing is not driving the market. What is driving the market? The Fed, and more specifically, the concept that you're going to get lower rates because you're going to get a change in the Fed seat. And it does appear that the kind of drip, drip, drip of getting Powell out of the seat is like increasing over the weekend and into this week. Um, it's not a great thing to have instability in that seat. And it doesn't mean that if Jerome Powell stepped down as chair, he would actually he could still step down and be a member of the Fed board, but not be chair. Traditionally, Fed chairs have actually stepped all the way off the Fed when they're finished their chairmanship. So he's got a couple of levers to pull. I mean, needless to say, he's been somewhat emasculated now. We're definitely dealing with a lame duck Fed, and we'll see how, who takes over there. Nvidia is now bigger than all of Japan. So Japan, if you look down at the bottom, is 5% of the global equity market. The US is 64. Nvidia alone, which is 5 point something percent, is greater than all the market cap of Japan. And so if you ask me to, what would you trade all of the stocks in Japan for one stock in the US, I'd probably do that. So, concentration is really, these are the things that sort of scare me. And I guess we're getting into the slides, where they used to say, and now for something really scary. Concentration is really getting up there. The next slide, another thing that people are considering scary is a brewing little crisis in endowments. Sometimes it only takes you 15 years to be right. In this case, I was 15 years early. My time at Cornell during and kind of just after the financial crisis, I was very focused on endowment liquidity and our ratio of liquid to illiquid assets. This chart shows the ratio of unfunded calls, so the money that the endowments would have to render into their PE holdings versus their liquid. This is exactly the ratio I worked on at Cornell and was very concerned about. I'm happy to see Cornell at the bottom of this list. That's good, showing that their ratio of unfunded to liquid holdings is not bad. Brown and Harvard are certainly at the top of this list with their ratio of unfundeds. And so, this could be a problem if you have a lot of deals that are done with a tax-free dependency on your tax status. As I understand it, some of these endowments actually have swaps and structures that are dependent upon their tax status, their tax-free status. And as we know, that's under assault right now by the current administration. So this, stay tuned here. We're not done. Another, I guess, if we're ending on bad news, this is the third slide of bad news. They have not fixed the debt. The budget impasse that got solved about 2 weeks ago didn't do anything. The long-term debt will actually increase over the next few years. And I guess we're hoping to just grow our way out of it. Which leads us to kind of the summary of the what's hot, what's not. Growth in the U.S. is extremely hot this quarter. Value was not. Tariffs have been very hot and have actually driven the markets. What's not is recession fears. People got over their fear of recession or tariffs causing recession, and the markets have been at new highs really every day this week. Precious metals have been hot. That includes palladium, platinum, silver. We recently expanded our precious metals holdings to a little bit of silver relative to gold. And we were rewarded with, I think, a 10 or a 15% gain right away. Versus the US dollar. Dollar's down 10%. So it kind of all makes sense. If the budget looks bad and there's instability because of tariffs, gold goes up and the dollar goes down because people are not, happy with what we're doing with our budget. So it does the dollar, metals, and the fiscal budget all kind of makes sense. It all hangs together. Crypto and AI packages, if your son or daughter is a crypto engineer, they are trading like NFL quarterbacks or trading more like multiples of NFL quarterbacks. The pay packages being offered to AI are pretty amazing out there. And versus what's not hot, U.S. government fiscal prudence. Hedge funds have now come roaring back. So we're getting actually some good long and short returns for the first time in 15 years. And M&A in the markets is picking up a little. although IPOs have now finally, after 3 years, we haven't seen any IPOs, but the M&A market has picked up a little bit. Although a lot of the M&A is peer-to-peer, PE to PE sales. One of the hottest areas is European and defense stocks, which makes sense because Europe has to rearm and has pledged a big chunk of their GDP to do it. And the worst sector in the US, and it's not just UNH and their self-inflicted problems, is healthcare. UNH and also biotech. They're in a death march across the desert with the healthcare sector. And this has been kind of a multi-year thing. Southern state schools, impossible to get into. UNC Chapel Hill, Vanderbilt, Clemson, Auburn, very hot. Ivy League, less hot, with all due respect to my daughter. And also, if we were having an Oval Office popularity contest, Scott Besson is hot, and obviously the Elon Musk is not. That's kind of a little bit of a market summary for the quarter. I'm going to pass it along to Connor, who is going to talk about some of kind of the macro stuff and some of the data that we're seeing out there.
Thanks, John. Thanks, everybody, for joining. As John mentioned, John does a great job at highlighting some of the big themes around the world and asset classes, and I thought I would just go a little bit deeper underneath the hood here. Why don't we jump into slide 16? I think this is one of the main headlines driving pretty much anything as it relates to risk assets. It's Fed policy and the hiking cycle, and Trump obviously going after Powell. It's going to really determine what happens over the next 12 to 18 months. I think in-house we maybe think that some of this is getting priced in already. But keeping interest rates this high as CPI is kind of moderated around 2.5-ish%, and unemployment stayed around 4%, is definitely interesting, and we'll dig into how that's impacted credit, equities, and the housing market. Slide 17 again reinforces the point. We've come all the way from 9 to about 2.5%. I think the concern on the Fed side is sticky inflation around 2.5 to 3%, and they're trying to look through tariffs and what the impact of that's going to be. If you go to slide 18, I think this is a well commented data point people love to mention, but I'll start at the bottom. This is just a chart of U.S. and China tariffs against each other starting in February, and as you can see, we went up and up and up, down and down and down. So a lot of uncertainty, and that's translated to a reduced shipping rates into the U.S. from China. So the top left is container ship tonnage. It's been about cut in half this quarter. And so if shipping is getting cut in half into the United States, how does that translate to cost of goods and things that we import from China? So that is definitely one point I think the Fed is considering, and it's not an unfair point to consider. Slide 19, uncertainty as it relates to credit. It's really interesting. The U.S. Economic Policy Uncertainty Index is just a collection of leading economic indicators and how quickly they're moving and how that relates to expressing uncertainty. And the market is in the dark green. What's really interesting is credit spreads historically have at least trended with uncertainty, which makes a lot of sense. This year, that has not been the case. This is IG corporate credit, meaning the yield you're getting over the risk-free rate in investment grade bonds. It's been historically tight and continues to be historically tight. Alex and I were talking about this in an investment meeting a week or 2 weeks ago, and this maybe one of the reasons why is balance sheets look pretty strong for corporations. They've obviously shored up and refinanced debt when interest rates are very low. And it just seems like the bond market is not very concerned as it relates to the status of investment grade and high yield bonds, as default rates have still stayed pretty low. Slide 20. This is an area where there is some pain in the world, and I'm sure everybody's experiencing this if you didn't lock in an interest rate at 3.5%. So I guess there's the haves and that, or the people who did and didn't do this. But the interest rates have been elevated now that risk-free rates rose. So mortgage rates are now around 7% in the light blue. And as you would expect, total existing home sales have declined around 2 million units. And so the housing market's kind of frozen. And again, I know housing's local, but if you look at Florida and Texas, Arizona, North Carolina, definitely a bit of a challenged market, which isn't great. And I think Trump tweeted maybe just a few hours ago on this that housing is lagging because interest rates are so high. So this is one of the main concerns I think the administration has. The other concern around interest rates being so high is debt servicing cost. If we brought rates down by 200 basis points, we could probably, the estimates are $500 billion to $1 trillion in debt servicing. Slide 21. Moving into equities, this speaks to John's point, one around concentration in the United States and the exposure we have there. When we think about global portfolios, 20% of the equity market in the left-hand side, so $18.5 trillion of our U.S. equity market is foreign-owned. So if we have tariff issues, dollar weakening, a flight out of what was considered safety, which is the U.S. assets, what does that do to U.S. equity indices? And we've seen like a hint of that recently. Obviously with international equities outperforming U.S. equities, but it's something we're very cognizant of as we're constructing the portfolios. On the next slide, John stole the thunder on this, but he mentioned NVIDIA's concentration in the global equity market index. So as a part of MSCI ACWI index, NVIDIA has a larger market capitalization than Japan, UK, China, Canada, France, and Germany. So it's just pretty astounding that one company in the United States could have, based off of valuation, be more expensive, have a greater value than other countries. So again, if you're considering the possibility that money can move out of the United States equity market, and NVIDIA is a huge part of that, then you just have to think about your portfolio positioning. Slide 23, heading into Mag 7, we've seen bifurcated returns in the Mag 7 this year. Meta, Microsoft, NVIDIA have held in, with Microsoft and NVIDIA outperforming the S&P, Microsoft and Meta outperforming the S&P, and then Amazon, Google, Tesla, and Apple have negative returns this year. A lot of that has to do with the AI race and how the market's reformulating what companies can continue to grow. I think everybody knows ChatGPT has stolen, it's taken a lot of search share from Google, which is very important to Google's revenue model. And we could go on and on. Page 24 highlights kind of maybe where we could pull some of the next sets of companies that could outperform and continue to grow given the move in AI. GE Vernova is one. Nuclear, alternative energy, Palantir's AI consulting, TSMC is chips. And so, you could look at the year-to-date performance of these baskets, and it's interesting to consider what the next few years could look like for certain types of equities. And then 25 is talking about not just concentration, but how well priced or how intensely priced equity markets are. Large cap earning reports this year, beats are not really being rewarded. You can see in the left-hand side with the dark red line. Companies that are beating earnings expectations are flat to down over the next 2 months. And on the right-hand side, companies that miss earnings end up being on average down 5% 2 months forward. So that tells us that expectations are extremely high going forward for the equity market. And then, 26, slide 26 is bringing back flashbacks to 2021. Not necessarily healthy signs. We're getting back into the Wall Street bet moves. I mean, today, I made this chart yesterday. Kohl's was targeted as a short squeeze where everybody on Wall Street bets decided to buy options in the stock. I think today, Open Door, Krispy Kreme, and a few other stocks that have high short interest are getting targeted. And so I just pulled off of Wall Street Bets somebody who claims they made $15,000 off of options. So this is just showing you retail mania is still existing and growing further, which is not necessarily signs of a healthy market. But that said, I'm going to pass it over to Alex.
Thanks, Connor. I'll briefly walk us through some of the investments outside of traditional stocks and bonds that our clients have exposure to. First, I'm sure many of you have heard us discuss our gold holdings in the past. As a reminder, most of our clients own gold through a proprietary LP fund we set up, owns physical bars in a vault in Dallas, Texas. And John also alluded that the most recent addition to our precious metals exposure has been silver, which we've been legging into over the last 2 months. You can see here both gold and silver materially outperformed the S&P 500 this year, but in gold's case, that outperformance stretches all the way back to 2022 as the Fed's rate hiking cycle began. This chart we've also shown in the past, just updating, we can see the ETF holdings of gold in orange overlaid against spot gold prices in blue. Only in the last 12 months did retail flows into gold turn positive after what was a 4-year downtrend. The better part of gold's rally since 2022, driven largely by foreign central bank buying as they sought to reduce their US dollar holdings. We do think the retail investors are just moving back into gold and that this trend has legs, especially in the face of US debt issues and potential rate cuts. This next slide is that exact same chart for silver, where the dynamics are almost identical. Beyond flows, silver's been in a structural supply deficit for 4 years, which is expected to continue into the end of 2025. This imbalance has been driven by rising industrial demand, stagnant mine production, and a dwindling of above ground reserves used to bridge that gap. And while this exposure is small for clients, we do think it pairs nicely next to clients' gold holdings that have outperformed phenomenally since 2022. Now, we can't talk about alternative assets without discussing crypto. Bitcoin remains a polarizing topic amongst our clients, but in light of this administration support, especially with the Genius Act announced on Friday, and along with the sheer scale these assets have reached, we can no longer ignore them. You can see here on the left, crypto assets across 4 trillion total market cap, reaching GDP levels equivalent to the 6th largest country in the world. And then here on the right, another chart from Coatue, Bitcoin alone would be the 5th largest global tech company today. So in my view, Bitcoin has moved beyond its stated goal of a decentralized asset held on the blockchain. I mean, BlackRock alone has 88 billion of assets sitting in IBIT on Schwab and Fidelity brokerage platforms. So it's begun to behave in a less pro-cyclical manner. There's been less correlation to growth assets, and we're taking it seriously as an asset class that has potential use in diversified portfolios. Now onto hedge funds. This page highlights a handful of the funds our clients have exposure to. It's been an incredibly strong year. Half of our fund allocations are actually outperforming the S&P on an absolute basis, even with lower net equity exposure. Year to date alone, our hedge fund portfolio is up 9.7%, and is up just shy of 17% over the last 12 months, outperforming the stock market over both those periods. As a reminder, our hedge fund strategy is not to dampen volatility or smooth returns, but it's to generate kind of punchier absolute returns through unique or idiosyncratic names and themes. On the next slide, I want to shout out one of those managers. Last quarter, we discussed Flat-Footed, who remains our best performer year to date. But here we have another fund that exemplifies our goal of generating those uncorrelated returns. Callaghan Partners invest in small cap healthcare, targeting biotech, pharma, and med device companies. They take an activist approach. They engage with leadership. They can dictate outcomes through their board representation or restructurings. We've been co-investing alongside Callaghan back to 2017 or 2018, and sat on the sidelines as they launched their first commingled fund until we made initial allocation in Q4 of last year. But since their launch, they've gained 126% inception to date, net of fees, nearly tripling the S&P 500. But more impressively, their universe, represented by the XBI Biotech Index, has actually been down in 2 of the last 4 years and has declined 11% over the life of the firm. So year to date, Callaghan's up 23%. The XBI is down just shy of 8. And just an example of a deep value, fundamentally driven firm that we believe can, continue to generate strong returns regardless of the overall market environment. Another manager outside of our hedge fund portfolio, this is more rare for us, but want to highlight Kimmeridge. Many of you have heard us speak poorly about high fee, long lockup private equity funds. However, we will occasionally allocate to PE in a targeted manner, especially when we see some sort of dislocation. Going back to 2021, we noticed most of the large private equity incumbents had exited traditional oil and gas businesses, driven by ESG mandates, which made fossil fuels uninvestable. We were drawn to Kimmeridge's model of acquiring energy assets, but operating them in-house, removing one of the typical layers of costs in traditional PE. Kimmeridge was early to the thesis that we are decades away from renewables replacing fossil fuels, and that while solar and nuclear will take share, natural gas is what would in fact be the energy transition fuel of the future. And in addition to switching from coal to natural gas, the AI boom and subsequent power needs to fuel that provide an even stronger tailwind here. So just highlighting, Kimmeridge recently announced a $615 million strategic investment from Mubadala Energy into Kimmeridge's South Texas natural gas project, where they're building a fully integrated gas company from upstream to midstream and ultimately to liquefaction facilities for international exports. Next, this slide highlights some of our historical co-investment activity. Shaded boxes on the right are opportunities we've exited, those on the left being currently active. We're continuing to find attractive opportunities across public markets, private markets, equity, credit, and these are things that are not widely marketed to the investing community. Overall, our public or liquid co-investments within our fund this year, these are all opportunities that are priced regularly, so I'm excluding the private stuff, has gained 23% through June and 29% over the last 12 months. So very pleased with how our co-investment book's performing, which lastly brings me to our partners fund. This is our actively managed, call it best ideas portfolio. A handful of our clients and partners use this portfolio to invest capital in a liquid manner that we can then draw down on to fund new co-investment opportunities. It's a slightly more aggressive strategy, but it's got our best ideas kind of 10 stock portfolio that John manages directly in-house, alongside some of our highest conviction international managers and some gold. And that strategy has gained just shy of 11% through June and nearly 20 over the last 12 months. So good start to the year across the board. And I think Lucy's now going to open it up to Q&A.
Yes, thank you everyone that sent in questions leading up to today and throughout the session. The first question we got was, which U.S. sectors have benefited and suffered most from Trump's tariffs so far?
Connor, do you want to take that?
Yeah, I think precious metals have done very, very well, and we've emphasized that point greatly. AI and then crypto. AI has had a pretty big resurgence. I'm not sure that has been impacted by tariffs. Crypto, again, not really tariff related, but regulatory related in the United States. Adoption of the asset class, and as John mentioned, healthcare has been the worst performing sector. I think Alex sent around some data this morning that said relative to the S&P's PE, it's in like the 0 percentile range. Healthcare valuation is in the 0 percentile range relative to US PE.
The cheapest it's been in history.
Yeah, ever. So UNH is down like 70%, as we've mentioned, biotech. So those areas have suffered pretty significantly.
Thanks, Connor. Is PermCap's precious metals bet driven by market liquidity, increased government spending, or something else?
I wouldn't call it a bet. I mean, a bet would be that, we buy it for one quarter and we hope it goes up. We have had gold as a part of our portfolios for 10 years plus. And we're probably almost dating all the way back to the inception of the firm. We've always had a modest amount of gold. And more recently, over the last 2 or 3 years, we've had, our clients own somewhere between 5 and 20%, depending on, their tolerance of gold. We viewed it as, if inflation goes up, you win. If bad things happen in the stock market, you win. If the U.S. debt gets worse, you win. And And so we got that all right. I think what we might have missed was crypto wins more because people were looking for an alternative to stocks and bonds and an alternative to paper currencies. And so, adding silver, we added silver, and I'll credit Xander Keogh, who's the newest member of our team in New York. Xander came in with a 2-page piece of research and brought it to our attention that the silver gold ratio, which I didn't even know what that was before Xander put it in front of us, had for the second time in history crossed over 100. And that was the number of ounces of silver it took to buy 1 ounce of gold, which basically said silver is way underpriced relative since the Hunt brothers tried to corner the silver market. And so on a relative basis, we kind of shifted some of our gold into silver. And then that worked very quickly. But again, if you look at platinum and palladium, which we have not owned, the rallies in platinum have been neck breaking. And when you take a look at it, so all these metals are moving, and the platinum market is a lot less liquid than gold. You can buy a lot of gold really fast, and you can buy a lot of silver really fast. Platinum and palladium are smaller, more liquid markets, and they look like a lot of money is trying to move into them really fast. So I think people are really scraping around trying to find alternatives to currencies. And it's not just limited to gold. And I put crypto in that alternative to stocks and bonds.
Just 2 other points. Also, from an asset allocation perspective, bonds become quite correlated to equities. So if you're trying to diversify your portfolio, gold has just been a better alternative. So you've probably noticed in most of your client portfolios that your bond allocations have shrunk and your gold allocations have grown, which has helped for a stronger risk-adjusted return. John, there's a follow-up question that said, is there a material difference in owning physical gold outright versus owning IAU, which we own both sometimes together for clients, but how would you describe or how would you discuss how we think about owning those 2 things separately?
Our gold, we tend to own 2/3 physical, 1/3 IAU. Our gold storage now, and there's a fee to owning IAU, which is 30 or 50 basis points, somewhere in there. I forget, GLD and IAU are very similar. I think our storage fees in our physical gold vault now, all in, are cheaper than owning the ETF. And we know where our gold is, and it cannot be loaned out. It cannot be hypothecated. It cannot be included as part of a derivative. It sits on a shelf with serial numbers, and we have the bar count. And so, and our auditor has the bar count. So that is kind of the sleep at night. If I want to worry about my insurance policy, I want to make sure the insurance policy is going to pay off. A lot's been written about. Now, I don't have a problem with ETFs. ETFs are fine and liquid, but we tend to use the ETF as the excess. That's the portion that if, like on Trump tariff day, when the S&P is down 1,200 points, we're selling our IAU, which is up in a down market, to purchase equities. So that's the liquid portion. Selling physical bars of gold and getting the money out at the end of the month is a little bit more slow. So that's why we use the gold ETF.
John, one more point, just I kind of liken it to Bitcoin. If you're a Bitcoin purist, you own it on the blockchain because you don't want to be beholden to any centralized brokerage firm or bank. If you own the ETF, you want it as a diversifier in your portfolio. So clients who want to be able to take physical delivery of gold bars, should something wonky happen in financial markets or with access to brokerage accounts, there's just a bit of a difference in mentality behind what purpose it serves within your portfolio. But it's actually very similar to the blockchain Bitcoin ownership model versus buying an ETF that sits at Schwab.
That's right. And I personally, I think Bitcoin is going up in value because the demand for it is going high. I own it, but I own it through the ETF because Alex showed me a little key fob thing, and I was sure I was going to lose it. So I knew I wouldn't lose my ETF.
Okay, thank you. Next question is fixed income still attractive on a risk-adjusted basis, or is it time to reach for more beta?
Alex, why don't you take that?
We still think it's attractive. I mean, all things are relative, and Connor touched on spreads being incredibly tight. I think what the market has gotten comfortable with is that all-in yields are still very attractive. Historically, we have preferred to stay shorter duration within our credit portfolio. So take a little more credit risk, but do so without dipping into kind of triple C land. And we still think that's a really attractive pocket of the market. You can still find shorter duration credit ideas that are in the 8, 9, in some cases 10% yield range. So if I had to look holistically over the last 8 to 12 months, I'd say we have probably brought our credit exposure down relative to equities, and we've high graded that somewhat into some more investment grade, sub asset classes within credit. So not just IG, but things like preferreds. But I don't think you'll see us with zero credit exposure. I'd say our clients across the board have a healthy mix of, between 20 and 40% in a defensive, credity, high yieldy portfolio, and then our international mix of equities and alternatives making up the balance.
Thanks, Alex. The next question is, how likely is Powell's removal and what assets would benefit if this happened?
So I think the poly market is saying it's around 20 to 30% right now. And that was a relatively accurate indicator of the cabinet positions if you go back about 6 months or 8 months. If everybody goes back and reads this book, if people have time this summer, there's an 800-page book called The Creature from Jekyll Island, which is the history of the formation of the Fed. It's a real page turner, and it's great for the beach if you're looking to fall asleep. But it goes back and gives you the history of the creation of the Fed and why J.P. Morgan forced it after bailing out the U.S. government multiple times in the 20s. And coincidentally, it was actually formed down here on Jekyll Island, which is not too far away. I've been to visit it. Give it a skip. It's interesting historically, but it's not worth the drive. But with regard to the Fed, if you read that book and you read up a little bit, you'll see that, the Fed is sort of this fourth branch of government that got tacked on and has maintained independence. And I think, probably it would be bad for the bond market to not have an independent Fed. But I think this is the first time really in my investment lifetime where we're questioning, how it works, and how does this kind of live outside the appointed positions. Anyway, so I think it would be bad for the bond market. It would be a little destabilizing, but I think it's difficult to kind of maintain your position given the number of people who kind of want you not at the party anymore.
John, you said you would take that trade when talking about NVIDIA and Japan. Can you clarify which side?
Yeah, I'd rather have all the stocks in Japan versus one stock anywhere.
Okay, and then the last question we got, this one's for you, John. Who is the next Citadel speaker?
That is in process. Actually, Xander, if you put on 38, for those of you who don't live locally down here, our last two, we're going into our third year. We started the speaker series at the Citadel, where I'm the board of the business school. Our spring speaker was Bill Ackman. I don't know if Bill's on today. He probably isn't, but someone should tell him he needs to be on the next one. Please pass on. Bill was so great and gracious, and he flew down here, spent the day with us, and spoke at the Citadel. We had a standing room only crowd of like 325 people. And it was absolutely fantastic. Prior to him, we had Scott Bessent, who, is my old boss from long ago. So after Bill and Scott, I'm not really sure who we're going to get from there. So, I'm going to be running out of prominent speakers, and Alex and Connor are going to wind up juggling for the audience probably next time. So, but we'll reach into our bag of tricks and come up with someone. The next Citadel speaker event, I think, is on October 21st. So if you do plan on being in the Charleston area, please join us. And then separately, we also hosted our first big conference in Charleston for our faith-based investment clients, and that was the Vine conference. We've announced that we're gonna repeat it. We had about 50 people down here. It was a fantastic 3 days. We're gonna do the same thing next year, but double it in size. And we've already picked the dates of Wednesday, April 29th to Friday, May 1st. And we're coinciding it. We're ending with the Brandon Lake concert. For those of you who live in the South or the West, you know who Brandon Lake is. And that'll be a good end to the conference. So it was a very busy spring. And with the Citadel, next Citadel thing will be October 20th. Lucy, anything else?
No, that was the last question. Thank you, John.
If no one has any other questions, thank you very much for joining us. We broke speed records this time, so we're done in 43 minutes. And thank you very much to our clients for entrusting us and kind of continuing to entrust us. Although with a quarter like this, it's easy because everything worked pretty well. Please contact us if you'd like copies of the slides, or if you'd like to come visit us in either New York or Charleston. Thanks very much and have a great day.